Okay, dear students, good afternoon to everyone. Let's start. It's our first live revision class, and we'll be revising whatever so far we have studied, not the entire area, but major chunk of that area which we have already studied. So we'll be revising that area, but through questions. Okay. And on the portal, I've already solved question of section C as well as section B. So I've given you the flavor in my regular classes. Or the flavor which I've already given, that is section C flavor is already uploaded on the portal as well as section B. This is what comes MCQs, they come in section A. We are starting from question 8 and you people are studying Finance Act 2025. Okay. And this is from the latest kit, and I believe everyone is having this kit also. I believe. Just a minute, let me change the color. Okay. Which two of the following statements are true in relation to Zara's income tax liability for the tax year 25-26? Which two of the following statements are true? There are 4 statements, so you should be able to identify which is 2 statements are true. If you are unable to identify which 2 statements are true, then you should be able to identify which 2 statements are not true. That will also lead you to the correct answer. So at least you should be having expertise in one area. Either you can identify which 2 are correct properly. If not, then at least try to identify which 2 are not correct. Let's see. Danny and Zara are married couple. Okay. They jointly own residential property which is let to tenant. Now stop. Jointly own residential property. Students, if you recall the concept of jointly owned asset, in case of jointly owned asset, whatever income is coming from that jointly owned asset, that will be split between husband and wife, between couple, between spouses, 50-50%. Irrespective of ownership, because it is very much possible that actual ownership might not be 50-50%, but still, whatever the income comes, it will be shared between husband and wife 50-50%, unless they both make a joint election to HMRC about their actual ownership. Only after that election, whatever the income comes, that will be split according to their actual ownership. Unless they are not making any joint election regarding their actual ownership, whatever income is coming from a jointly owned husband and wife, 50-50%. I hope it is clear to everyone. In the tax year 25-26, the property income from the property is £20,000. Dene owns 25% of the property and Zara owns 75%. No election has been made in relation to the ownership of the property. Students, no election has been made. So how will you split this 20,000? Will you still be splitting between into 25-75% or 50-50? Kindly reply in the chat box. I can't see anything in the chat box. Students, okay, 50-50 is the correct answer. Thank you. Because there's no, they have not made any joint election regarding their actual ownership. So it has to be split 50-50%, means each spouse will get 10,000. Each one of them will be getting £10,000. Okay. Zara earns employment income 85,000. Danny received 2252 of child benefit in the tax year 25-26. Danny has no other income. So Danny does not have any other income. Okay, fine. The question A, part A says Zara's taxable income is 82,430. Let's check. Zara's employment income is 85,000. Zara's property income is 10,000. Total becomes 95. Let's deduct the personal allowance. And the personal allowance is 12,570. 95,000 minus 12,570. Students, I am getting taxable income of Zara 82,430. Is that clear, students? So statement 1 is correct. So simply Zara's taxable income is 82,430. Zara can reduce her income tax liability by claiming the transferable personal allowance or the marriage allowance. Can I say false? Why it is false? This is the question. Husband and wife, they can transfer 10% of personal allowance, which is 1260. But can I say marriage allowance is only possible? Marriage allowance is only possible when husband and wife both are basic rate taxpayer. Repeat. Marriage allowance, which is 10% of the personal allowance 1260, you can only transfer, one spouse can only transfer 1260 to another spouse when both are basic rate taxpayer. If you look at the question, Zara is not a basic rate taxpayer. Logically, Zara is a higher rate taxpayer. Since one of the spouse is a higher rate taxpayer, so marriage allowance is not available. That is why it is false. So 2B is incorrect. It would be beneficial to Zara if the couple were to make a joint election to HMRC specifying their actual ownership share in the residential property. First, try to understand what examiner is asking you. It would be beneficial for whom? Zara. Now let's see. What is the ownership of Denny? Denny's ownership is 25%. And logically, Denny is a basic rate taxpayer. Zara's actual ownership is 75%, and Zara is a higher rate taxpayer. Now try to understand. Right now, 10,000 of the property income goes to Zara. Logically, on this 10,000, you can say Zara is paying 40% income tax because Zara is a higher rate taxpayer. Now, examiner is saying if they make joint elections, Zara will get the benefit. Her income tax liability will reduce. Actually, her liability will increase. How? If they make joint election, then 75% of the property income will go to Zara, which is 15,000. Logically, Zara is already a higher rate taxpayer. Zara is already paying 40% on that 10,000. Now, instead of paying 40% on 10,000 due to this election, she will end up by paying 40% on 15,000. So logically, her income tax liability will not reduce. It will actually increase because Zara is a higher taxpayer and her ownership is more than 50%. So this election is going to be dangerous for Zara, and this is not going to be beneficial. Yes, you can say it will be beneficial for HMRC because she will end up by paying more tax. HMRC will generate more money, but we are not solving for HMRC, we are solving for Zara. So can I say it is not beneficial for Zara? Is that clear, students? Finally, a child benefit charge 2252 will be added to Zara's income tax liability. This is absolutely correct. Why this absolutely correct? Let me tell you. No matter who receives child benefit, even though child benefit, who has received? Dene. Dene has received the child benefit 2252. But the point is, there will be child benefit charge equal to the full amount which Dene has received. No matter who has received the child benefit, according to HMRC, we have to check out of husband and wife, who is having higher net income? So Zara is the one who is having higher net income. In fact, Zara's adjusted net income here is more than 80,000. So any one of the spouse is having more than 80,000 adjusted net income, then child benefit charge becomes 100%. If you recall the formula of child benefit charge, we take the net income, whatever that net income individual is having, means adjusted net income. Let me just write a formula for you. We take adjusted net income minus 60,000 divided by 200. Whatever comes, that will be 1%. If ANI is 80,000 or more, then child benefit charge will be 100%. Even though the benefit was received by Denny, but child benefit charge will apply on Zara. Whoever is having a higher net income, on that spouse, child benefit charge will apply. Here, the child benefit charge will be 100%. A child benefit charge 2252 will be added to Zara's income tax liability. So logically, the answer is A and D. What is, okay, you can see that, students, Finance Act 2025, your latest Kaplan kit. The good thing is in FA 25, there are majority of the, I think a vast majority of FA 25 is same like 24. Not 100%, there is a little change, but this time, normally the change comes, a significant portion changes, but this time the changes, I would say, minimal changes there. But obviously, kit you people are have to use this one, FA 25. What is Venice income tax liability for the tax year 25-26? They're asking income tax liability of Vinay. Gina and Vinay are married couple, fine. In the tax year 25-26, Gina had a salary 5,000. Vinay had a property income 40,650. Wow. They have made an election to transfer the fixed amount of personal allowance from Gina to Vinay, which is logical. Number one, they both are basic rate taxpayer. Now you might be, some of the students, they just might get confused by looking at Vinay's property income, which is 40,650. Actually, by looking at 40,650, you should not decide either Vinay is a basic rate taxpayer or a higher rate taxpayer. You should deduct first personal allowance from here, which is 12,570 to get the true picture. Either Vinay is a basic rate taxpayer or not, 40,650 minus 12,570. Now you can see that Vinay's taxable income is only 28,080. So obviously Vinay is a basic rate taxpayer because marriage allowance is only available when both husband and wife, they are basic rate taxpayer. Jenny, of course, is just having a salary of 5,000 pounds. So even by looking at five directly, you can decide that Jenny is a basic rate taxpayer. But Vinay, by looking at 40,650, the decision is going to be incorrect. First, you should be deducting personal allowance from Vinay's income. Now you can see that taxable income of Vinay is less than 37,700. It is not exceeding 37,700. So both are basic rate taxpayer. So simply 28,080. Property income is a non-saving income. Non-saving income basic rate band, applicable tax rate is 20%. Let me use the calculator. I'm getting 5616. From this 5616 students, we will deduct marriage allowance, which is 12,060 into 20%. Less marriage allowance 1260 into 20%, 252. Let me correct this. Just a minute. There's a 252. I'm getting students 5364. Okay, there's something in the chat box as well. Option C, thank you. Option C is the correct answer. But student, if let me just give you the recap. Marriage allowance is only available when husband and wife both are basic rate taxpayer, number one. Number two, between husband and wife, if one of them is unable to utilize his or her entire personal allowance, that spouse will actually transfer 12602 to another spouse. And exactly 1260 you have to transfer, not less than that, not more than that. Another rule which you need to know, recipient spouse personal allowance will not increase by 1260. The presentation is for the recipient spouse, you just need to first normally calculate the income tax liability by taking its normal personal allowance, which we did. After that, simply you need to deduct marriage allowance. And that the marriage allowance is 1260 multiplied by 20%, you will get 252. That 252 actually reduces the income tax liability of a recipient spouse. So personal allowance of recipient spouse will not increase by 1260. Recipient spouse income tax liability will reduce by 252. Okay. What is child benefit income tax charge for the tax year? 25-26. For the tax year 25-26, Chai has a salary of 66,200. Wow. She received the child benefit of 2252 during the tax year. What are they asking? What is the Chai's child benefit income tax charge? So let us first calculate child benefit charge percentage. Only income is salary. So this becomes adjusted net income minus 60,000 divided by 200. Whatever comes, that will be a percentage. So students, I'm getting 31. So that is going to be 31%. So child benefit charge will be 2252. Take 31% of that. Students, I'm getting 698.12. So obviously round down wherever it is needed. Always go for round down. 698. There was a in the chat box something. Option D. Thank you. Whenever it is required and you need to round, it is always round down. The percentage you will have to round down as well as the amount you will have to round down as well if it is needed. Here, of course, percentage, no need of round down. 31% will remain 31. Now let's move to another question. Amber is in employment earning annual salary 73,000. Wow. Her only other income is bank interest, which is 3,000 pound. Okay. She received a child benefit 2252 during the tax year 25-26. Select Amber's child benefit tax charge and method of collecting for the tax 25-26 by selecting the appropriate box in the table below. I'll come to the method of collection later on. First, let us calculate the amount of child benefit charge. Amber's salary is 73, interest 3, which becomes, it means, and there's no gross gift redemption, there's no gross PPC. So adjusted net income becomes 76,000 minus 60,000 divided by 200. Again, whatever comes, that is going to be a percentage. That is going to be a percentage. I'm getting 80%. 2252. Let's take 80% of that. 2252, 80%. Students, I'm getting, this is very important. Look at this. I'm getting 1801.6. Now listen to me. If any one of us who is a mathematician who loves maths, I believe majority loves maths. Mathematically, the answer should have been 1802. But here you are not supposed to follow the maths. You have to follow the rule of it made by HMRC. And HMRC says wherever it is required, round down, round down. If I go for round down, students 1801. So amount has to be 1801. Now method of collection, one is self-assessment, another is pay. First student, try to understand the pay. Pay as you earn. Pay as you earn. Student, pay as you earn. When I am an employee somewhere and I am getting my employment income, normally income tax on my employment income will be deducted under pay. But child benefit charge is not something relating to the employment income. Repeat, I'm working as an employee somewhere. Whenever I'm going to get my employment income, that will be after tax because normally pay will be deducted. Okay, fine. But child benefit charge, it is applied on me and I have to pay this to HMRC. Here, pay does not work. So this is 1801. I have to pay to HMRC. This cannot be deducted at source. This cannot be deducted in advance. And it has no link with pay. So it means self-assessment. You are the one who has to look after this child benefit charge and you need to make the payment to HMRC. This will not be covered under pay. So the answer is A. Let's see any. I hope now it is very much clear about that round down rule also. Okay, fine. And I said round down is applicable on both. It is applicable on percentage as well as on amount. Again, where it is needed. Like here it was needed, very much needed. Even though I'm repeating it again, mathematically it should have been 1802, but we are not following maths here. You have to follow what HMRC says if you want to get marks. If you are saying, no, sir, I'll follow maths, I don't need marks, then you will become above the tax paper. Then you are someone else. You are far more above taxation. Then you will be getting a very decent email from your examiner. Instead of result, there will be an email for you. Right now, I cannot tell you what they will say in that email. And I don't want to say. Okay, come here. Next question. Tick the appropriate box to show which of the following item of expenditure are deductible in the calculation of an individual's taxable income. Okay, fine. A contribution into personal pension scheme. Students, I said many times in my regular classes, when an individual is contributing to the personal pension scheme, there are three tax implications. Let me give you a recap. Whatever individual pays, it is 80%, 20% will be paid by HMRC. Number one. Number two, basic and higher rate band will be increased by gross PPC. And the last one is adjusted net income will reduce by gross PPC. But logically, when you are contributing in personal pension scheme, it is not a deductible expense. Contributing in personal pension scheme will not reduce your income. You can say it will reduce your income tax liability. How it will reduce your income tax liability? Basically, your basic and higher rate band will increase and you will get the benefit. But the main concept is it is not a deductible expense. So when you are contributing in personal pension scheme, it is not a deductible expense. It will not reduce your income. A charitable gift donation, exactly the same thing. Tax implications of gross gifted donation and gross PPC both are same. So personal pension and charitable gift donation both have the same tax implication. Again, nothing is mentioned. Whatever you have contributed in PPC, whatever gifted donation you have given, it is treated as 80%. 20% will be paid by HMRC. Both gross gifted donation and gross PPC, they increase basic and higher rate band and both reduces ANI also. But again, charitable gift donation is not a deductible expense. A contribution to an employer's occupational pension, yes, is a deductible expense. When an employee contributes in occupational pension plan, it is a deductible expense. It reduces employment income. But if your employer is contributing for you, if your employer is contributing for you in occupational pension plan, then it is an exempt benefit. Even your employer contributes for you in personal pension plan, that is also an exempt benefit. But when you are contributing being an employee in an occupational pension plan, it is deductible expense. It reduces your employment income. A charitable donation made under a payroll deduction scheme is a deductible expense. A charitable donation made under payroll deduction scheme. You just need to remember this payroll deduction scheme. Whatever you are donating is a deductible expense. Okay. Identify by ticking the appropriate box whether his interest payment represents qualifying interest, students, and therefore deductible from his total income or are not qualifying. Simply, you need to identify which one is a qualifying interest, which one is not a qualifying interest. Again, student, if you recall, we have of course discussed this qualifying interest in our regular classes. Assuming Mr. Y, I'm just assuming, okay. Assuming Mr. Y is an employee, Mr. Y takes the loan, number one, and from that loan, Mr. Y buys an asset. Let's say he buys a computer, and that computer Mr. Y is using in his employment. Now we'll say the loan which Mr. Y has taken, he has taken a loan for a qualifying purpose. And when you have taken a loan for a qualifying purpose, then whatever interest you will be paying, that is a qualifying interest. And logically, qualifying interest is not deducted from any individual source of income. Qualifying interest is deducted from the total income. But I've given you the one of the examples of a qualifying loan. Another example, assuming Mr. Y is a partner in a partnership firm. If Mr. Y is a partner in a partnership firm, Mr. Y takes the loan and give that loan to the partnership. Again, we'll say the loan which Mr. Y has taken is a qualifying loan. Another example could be if Mr. Y takes loan to buy shares in an employee controlled company. If you're buying shares in an employee controlled company, that is also a qualifying purpose. If you are taking a loan and you are contributing to the partnership, that is also a qualifying purpose. So let's see. Ephraim has been employed for many years, so you should be focusing on employment, and has also recently become a partner. So two areas, one is employment and another is partnership. He is in the process of completing his tax return and has asked your advice regarding the interest payment he has made. Of course, you can give a very good advice, and that honest advice from your could be that don't take advice from us. You can write this to Ephraim. That is going to be honest advice, but on that advice, you will not get any marks. So you have to give advice to Ephraim, either it is beneficial for him or not. Interest paid on a loan he incurred to purchase a laptop in his employment, students. Qualifying purpose. Interest paid on the mortgage of his own main private residence. Not qualifying. And first of all, student, look at this. Examiner also, they have given you the hint. If you read this information, look at the contacts. Ephraim employed has been employed, number one. Partner, number two. So logically, whatever the loan you are taking, somehow that loan should be used in an employment or in a partnership. Examiner has also given you the hint. If I'm taking a loan for my own home, it is again out of the context as well. Simply, it's not a qualifying interest. If you recall the regular lecture in which I have covered this qualifying interest topic. Okay, interest paid on an amount to he borrowed to finance the acquisition of 2000 shares in a quoted company. I said if you are buying shares in an employee controlled company, not quoted company. If you're taking the loan and to buy shares in an employee controlled company, then it is a qualifying purpose. If you are, so again, third one is not a qualifying purpose. Interest paid on a loan he took to invest capital in a partnership in order to become a partner. Qualifying purpose. And a student, whoever remembered the purpose, qualifying purposes here could have easily answered this question number 13. And let me tell you one thing, which I think I've said many times in my regular classes. Students, the entire taxation paper will not disturb you. I can guarantee you, it will not disturb you. If, provided that, if you remember all the rules, if you can memorize all the rules, and you need to memorize in such a quality that you should be able to recall the rule. So if you are in a position to recall the relevant rule at a relevant place, then taxation will not disturb you. But if you are someone who is unable to memorize the rules, unable to recall the rules, then a student, taxation will disturb you, and it will disturb you a lot. Because it's a rule-based paper, entire paper. So yes, it needs your memory skill, plus a lots of practice is needed. I'm not saying it is not needed, it is needed. But without, I would say, remembering the rules, without memorizing the rules, it becomes very difficult to tackle the paper. And obviously, the more you will be practicing, automatically you will be getting a grip on all the rules. But everything takes time, okay? Some of the students, they just get confused and they start, I would say, they just not get confused, but they also get demotivated very early. If you are looking a question and you are unable to recall the rule, it does no problem at all. You are not sitting in exam tomorrow. You have time. You can always go back and revise. So there is no need to get demotivated. So by looking at a question, if you are unable to recall the rules, it is very normal. It happens with everyone. When we were studying at that time, we used to face the same problem also. But how to overcome that problem? That there is only one way to overcome that problem, and that is revision, and practice. The more you will be practicing questions, automatically, and the more you will be revising the rules, automatically the time will come that you will be in a, inshallah, good position to recall all the rules at a relevant time, at a relevant place. What amount of personal allowance is INS entitled for the tax year 25-26? Personal allowance, if you recall, ANI, adjusted net income. Now I'll give you one hint. I've just written the heading adjusted net income. Now, majority of the students, they just go blank and they are unable to recall the format of ANI. That is, again, I'm saying perfectly fine because you have just started this taxation course. But if ANI comes, let's say 3-4 times, if it is coming again and again, and every time if you are unable to recall the rule, then it is dangerous. First 2 to 3 times, if you are unable to recall the rule, it's okay. But at least if ANI comes, let's say you are revising the lecture, I believe if the same thing comes like fourth or fifth times, then I can guarantee you will be in a position to recall the rules. But what I want every one of you, there's no need to get demotivated. Be calm, okay? Adjusted net income. Let me give you a recap. Net income less gross personal pension contribution. And how do we make personal pension contribution gross? Number one, nothing is mentioned. It is always 80%. It is net. So whatever amount, net amount is given, multiply that amount with 100 divided by 80 will make that net amount gross. Less gross gift aid donation. Gross gift aid donation. You will get ANI. If you recall the rule, if adjusted net income is more than 1 lakh, okay, there's a question. If adjusted net income is more than 1 lakh, then personal allowance will reduce. In fact, whoever is having ANI more than equal to 1,25,140, that individual will have personal allowance 0. Now let's read the question. Ains is a sole trader. Okay. During the tax year 25-26, she had taxable trading income. Simply her trading income was 1,06,800. Received dividend 1,500. Ains made a gifted donation 2,000 gross for the tax year 25-26. So let me use the calculator. 106 plus 1,500. Net income is 1,08,300. Student, from this net income will deduct this gross gifted donation 2,000. You will get ANI. Adjusted net income is 1,06,300. Now listen to me carefully. Here, examiner has given you the net income, which is 1,08,300. Examiner has given you the gross gift aid donation, which is 2,000. Adjusted net income is this. Now, some of the students, they read the question and again just to find out where is the gross PPC. Students, if gross PPC is not given, so it means it is not given. Even you read the question 10 times, it will not appear automatically. It is not something which is lost in the question, and if you read the question 10 times, it will appear in front of your eyes. So you should be confident enough. It is not necessary the entire format of ANI has to be fulfilled, and all the time examiner will give you the all three values. If gross PPC is not given, it's okay. Still, whatever the result comes, it is your adjusted net income. Now, personal allowance is 12,570. Less ANI is this, minus 1 lakh. This is adjusted net income minus 1 lakh into 50%. I'm getting 3,150. So 12,570 minus 3,150. Students, the personal allowance which INS will get is 9,420. INS will get personal allowance 9,420. Okay. Okay. Students, non-saving taxable income is 8,580. No issue at all. Just a minute. 8,580. Let's take 20% of this. 1,716. Okay. So non-saving income, which is 2,150 minus the personal allowance, gives us 8,580. Let me change this. 8,580 plus 2,400 plus 450. 11,430. The total is 11,000. Okay. By looking at 11,430, we can easily say this individual is a basic rate taxpayer. Can I say whoever is a basic rate taxpayer gets nil rate band 1,000 for their saving income? So saving nil rate band is 1,000 into 0% is obviously 0. Remaining 1,400 of the saving income falls in basic rate band. Applicable rate is 20%, 280. Look at the dividend income, which is 450. Can I say every individual, irrespective of their tax paying status, every individual gets nil rate band of nil rate band of £500 for their dividend income. So entire 450 actually falls in dividend nil rate band. So simply 1716 plus 280. Income tax liability is 1996. 1996. I hope it is clear to everyone. Whoever is a basic rate taxpayer gets nil rate band. £1,000 for the saving income. If someone is a higher rate taxpayer gets nil rate band £500 for the saving income, and someone who is an additional rate taxpayer gets no nil rate band for the saving income. But when it comes to dividend income, every individual, irrespective of their tax paying status, every individual, irrespective of their tax paying status, gets nil rate band of £500. I hope it is clear to everyone, and I hope I'm audible to everyone. One student was saying that I'm not audible, but according to my system, I'm audible. Yes, I'm audible. Okay. Okay, fine. Great. Harrison only income in the tax year 25-26 was dividend income, which is 56,950. What is Harrison income tax liability for the tax year 25-26? Students, dividend income 56,950. First 56,950. Personal allowance is 12,570. Let's deduct the personal allowance. 56,950 minus personal allowance. I'm getting 44,380. I think I've just said many times, every individual gets nil rate band of £500 for the dividend income, irrespective of the tax paying status. Okay, now what? Basic rate band is 37,700. Out of that, 500 is consumed by the nil rate band. So how much basic rate band is left? We still have the space in the basic rate band, 37,200. Dividend income which falls in the basic rate band, applicable rate is 8.75%. Applicable rate is 8.75%. I'm getting 3255. So total income is 44,380. Out of this 44,380, 500 we have taken in nil rate band. Then 37,200 we have taken in basic rate band. No more space in basic rate band. Whatever it comes now, that falls in higher rate band. Let's see how much falls in higher rate band. 6,680 actually falls in higher rate band. Dividend income, higher rate band, applicable income tax rate is 33.75%. And let me tell you, these rates, they will be given to you in exams. Okay. Students, I'm getting 2254.5. So make it 2255. 3255 plus 2255. 5,510. 5,510. Okay. Student, question number 17 you have to understand. Okay. This is, of course, you have not seen before that, but no issue at all. It's a very simple concept. It will hardly take 5 minutes. Inshallah, you will be able to understand. There's a question. The question says a basic rate band is 37,700. Great. Come here, guys. Look at this. Basic rate band is 37,700. Out of this 37,700, 500 we have taken in nil rate band. How much basic rate band is left? 37,200. If you add this 500 plus 37,200, you will get 37,700 basic rate band. Is that clear? And I think I did mention one thing. Okay, it is clear. Okay, students. How much will Manon include in saving incomes in respect of guilds in the tax year 25-26? Guilds, simply they are the government bonds. They are the government bonds. Now, please listen the rule carefully. It's very simple. Assuming Mr. Y is holding the bonds, holding the government bonds. Repeat. Mr. Y is holding the government bonds. In that case, and I'm working for the tax year 25-26. Now try to understand. Tax year 25-26 starts from 6 April 2025, ends on 5th April 2026. Now listen to me carefully. I'm saying assume that Mr. Y is holding government bonds, means guilds. Guilds, they are the government bonds. If Mr. Y is holding the government bonds, in that case, whatever interest Mr. Y has actually received during the tax year, that interest income is taxable. Repeat. Mr. Y holding government bonds, number one. And this is not the first year that he's holding this bond. The way back he bought it. Okay. So if you are holding the bonds which you bought the way back, then the rule says whatever interest income you have actually received, that is your interest income, saving income, and obviously on that you will have to pay tax. This is number one scenario. Interest received on guilds during the tax year, during the current tax year, becomes your saving income, taxable income. Let me just write saving income so that you should not get confused. Becomes your saving income, which you have actually received. Okay. One more scenario. Assuming Mr. Y bought gilts. I'm just putting a date on 31st July 2025. Assuming Mr. Y bought gilts on 31st July 2025. Okay. And on gilts, interest is received on 30th September, let's say 25, and 31st March 2026. But this time he bought during the tax year, okay? we are required to calculate interest income. So how will we calculate interest income? But in this case, in case number 1, Mr. Y bought these gilts the way back. He did not buy them in the current tax year. In case number 2, Mr. Y bought these gilts during the current tax year. Okay, now how will you calculate, I would say, interest income? First of all, of course, the relevant tax year is 6 April 2025 till 5th April 2025. And I said 26, 5th April 2026. I said one thing, that if you're holding government bonds, then interest, your saving income is which you have actually received, Okay. Here you will be receiving semi-annually interest, means after every 6 months, like interest you are going to receive on 30th September 25 and then March 26. Logically, after every 6 months, you will be getting interest. Okay. I'm just giving you the amount also. Let's say the amount of the bond is 400,000 and interest rate is 2%. Okay, fine. First of all, interest received on 30th September 25. 4 lakh, 2%, 6 months. Semi-annually, you will be getting the interest. I'm getting 4,000. Interest received 31st March 26 also fall in the relevant tax year. 2%, 6 by 12, 4,000. But now listen to me carefully. Students, in the second case, logically Mr. Y did not have these bonds in the previous tax year. This is the first time Mr. Y bought these government bonds during the current tax year. And in the current tax year, logically, please listen to me carefully. Logically, in the current tax year, Mr. Y's ownership is not 12 months. He bought on 31st July 2025. So, logically, technically, Mr. Y's ownership is not 12 months. Okay. You might be saying, sir, even if it is not 12 months, still the rule says whatever interest we will actually receive, that is your saving income. That's perfectly fine. But you need to understand one thing. When you bought during the tax year, when you bought these gilts, then how many months of the current tax years already passed? Current tax year started on 6 April 2025. From the start of the current tax year to the date of purchase, if you count the time period, April, May, June, July, 4 months. Logically, I just want to say one thing. Logically, these bonds were with another owner in the first 4 months of the current tax year. So then what rule says, now listen to me carefully. Whenever you are buying government bonds during the current tax year, then you have to deduct the interest which was accrued for the previous owner. Of course, for us it is not accrued. We have actually received the interest. But logically, interest accrued for the previous owner you have to deduct. So how many months these bonds were with the previous owner? 4 months. So less accrued interest on purchase. 4 lakh, 2%, 4 months. I'm getting 2667. So final answer will be your interest income, saving income. I'll be repeating this rule again, don't worry at all. So saving income is 5,333. Kindly listen to me carefully. Scenario number 2. Whenever you are buying the government bond during the tax year, whenever you are buying the government bonds during the tax year, all you need is just deduct the accrued interest at the time of purchase. Now you might be thinking why there is a need to deduct accrued interest at the time of purchase. If you want to understand the logic of that, so I'll try to give you the logic. Basically, why we are deducting? This is the question. What is the point of deducting? We are actually receiving 4,000 on 30th September 25. We'll be receiving 4,000 again on 31st March 2026. We'll be receiving 4,000. So what is the point of deducting 2667? What is the reasoning? What is the rationale behind deduction of 2667? Why the accrued interest at the time of purchase I'm deducting? Try to understand one thing. Logically, when you bought these bonds, so you actually did not pay only for the bonds, you have also paid for the accrued interest as well. So if I'm paying for the accrued interest, so it cannot be my income. If I'm buying something, that is not my income. So what is the logic behind that? Because the reasoning behind deduction of 2667 is we have actually paid for this interest. When we were buying the government bonds, we did not pay the price only for the bonds, we have actually paid for the accrued interest also. And this point you will be able to understand more, I would say clarity will come when you will see the same thing from the perspective of seller. Why I'm deducting, I'm giving the reason and I'll prove that in the next example. The reason behind deducting the 2667 is this, for this interest for 2667 actually I have paid for that. So when I have already made the payment of 2667, so that cannot be my income. Now why I'm paying this, let me explain this. One more example, third case and the last. There are three possibilities. One, you are having government bond since 3, 4, 5 years. Second, you might have bought during the tax year. Third, and the last possibility, you might have sold during the tax year. Assuming Mr. Y having 2%, 2 lakh pound gilts interest is received on, let's say on whatever, just a minute, something went wrong. Let's see one more case. Assuming Mr. Y is having 2%, 300,000 gilts interest is received on 30th September and 31st March. On 31st December 2025, Mr. Y sold gilts. And we are required to calculate saving income. 25, 26. Just calculate saving income of Mr. Y. Now, in the first case, Mr. Y was already having the bond. In the second case, Mr. Y bought gilts during the tax year. Now, during the tax year, Mr. Y is selling these bonds. Now listen, the rule is, in case of government bonds, the interest which you have actually received, that becomes your saving income. But if you are selling during the tax year, if you are selling the bond during the tax year, then you will have to take accrued interest also, which means that interest received, of course, on 30th September 2025, Mr. Y will receive 6 months interest. Let me use the calculator. Now listen to me carefully, students. If you are selling, if you are selling the bond during the tax year, then you have to take accrued interest as well. Till 30th September, I have taken the interest, and this is what we have actually received. Now, Mr. Y sold these bonds on December 25. Logically, on December 25, Mr. Y will not be actually receiving the interest income. But the rule says if during the tax year you are selling the government bonds, then you have to take the accrued interest. It means from 30th September 25 till December 25, we have got 3 months. So I will be taking accrued interest of 3 months till the date of disposal, accrued interest. Then I'll summarize the rule, don't worry at all. I think I'll get 1500. Total saving income is 4500. Now listen to me carefully, students. If you're already holding the government bonds, then saving income, interest income is the income which you have actually received during the tax year, number one. Number two, if during the tax year you bought government bonds, if during the current tax year you bought government bonds, in that case, first you have to calculate actual interest received during the tax year, and from that actual interest received during the tax year, you have to deduct accrued interest of the at the time of purchase. Because accrued interest at the time of purchase is logically the interest income of the previous owner, not your interest income. So logically, you will be deducting the accrued interest at the time of purchase. If you are selling during the tax year, then accrued interest, you will have to take it as income. So there are 3 possibilities, students. If you are already holding the government bonds for many years and in the current year you are not selling it, you are not buying it, then whatever interest you have actually received, that is your saving income. Second, during the tax year, if you bought the bond, then you have to deduct the accrued interest at the time of purchase. Last, if during the year you are selling government bonds, then actual interest received is your interest income plus accrued interest till the time of disposal becomes your interest income. So if I make the format, the current tax year is 25-26. On government bonds, I have to take interest income received. There's a possibility I might need to deduct accrued interest at the time of purchase. One more possibility, there's a possibility I might have to add accrued interest at the time of disposal. This is the entire format. Accrued interest at disposal. So logically, whatever interest you have received during the tax year, take that as an income. Less accrued interest. If you have bought the bonds during the tax year, then you need to deduct accrued interest at the time of purchasing the bonds. Add accrued interest at the time of when you are selling it. So student, this is the format on which you need to have a very good grip. I hope I've made all the scenarios very much clear. Now let's apply on the questions so that you can check how well you have understood the scenarios. Question number 17. Menon purchased 200,000 nominal guilds paying interest 1%. Purchase, okay? Be careful. Purchase. Paying interest 1% for 2 lakh 11. And interest is always paid and received on nominal value. Nominal value is 2 lakh. In September 2024, okay, previous tax year, interest is payable half yearly, 30th June and 31st December. He sold guilds during on December 25 for 2 lakh 13, including what? Accrued interest. How much will Menon include in the saving income in respect of the guilds in the tax year? Student, first of all, let me write the dates. Where should I write the dates? Let me write. Current tax year for which we are working is 2025-26. It starts from 6 April 25, ends on 5th April 26. Okay. During the tax year, of course, Menon has received interest on 30th June. 30th June 25 falls in the relevant tax year. Interest is always received and paid on nominal value. Nominal value is 2 lakh. 2 lakh, 1%, 6 by 12, I believe 1000. Now come here. Student, next interest, Mr. Menon might have received on 31st December. But logically, Mr. Menon has sold these bonds 1 month earlier. Instead of keeping the bond till 31st December, Menon has sold the bond on 1st December 25. If you are selling the bonds on 1st December 25, now I have to take accrued interest. Accrued interest at disposal. How many months? 5 months accrued interest. Because on 30th June 2025, I've received the interest of 6 months. Now, 5 months accrued interest at the time of disposal. 833. I'll get 1833. This is, I think, case number 3. When you are selling the bond during the current tax year, then you have to take accrued interest at the time of disposal. Now, let's see another question. And I really want you guys to try to properly understand this. Let's say Ahmed purchase. Oh, let me make this Mr. Y purchase. Mr. Y purchased 10,000 nominal value goods, paying interest how much? 2%. On first, look at this, 1st June 2025. Student, which case is this? Can I say 1st June 25 falls in the current tax year? 1st June 25 falls in the current tax year. We are looking for the second case, this one. When you are buying the bonds during the current tax year. Mr. Y purchased 10,000 nominal goods paying interest 2% for 11. How much you have paid, that is not important. Interest paid or received is on nominal value. Interest is payable half yearly on 31st March and 30th September. He sold the goods. Wow. Great. He sold the goods on 28 Feb 2026. Now, student, try to understand what is happening. He bought during the tax year. Okay. On 1st June. And he has also sold. Okay, fine. Now, let's see. How much will Mr. Y include the saving in respect of the goods in the tax year 25-26? He purchased 10,000 nominal value gilts, paying interest 2% on 1st June. So, first of all, student, 6 April 2025 till 5 April. This is my relevant tax year for which we are solving the question. Okay, fine. Interest is payable half yearly on 31st March and 30th September. First of all, on 30th September 25, definitely Mr. Y receives interest. There is no doubt about it. So 10,000 into 2%, 6 by 12. Students, I'm getting 100. Now stop. Actually, Mr. Y bought during the tax year. During the tax year. When you are buying bonds during the tax year, then you have to deduct the accrued interest till the date of purchase. Purchase date is 1st June 2025. Now try to understand. 31st March 25 interest was paid. It was received by the previous owner. And 31st March 25 falls in the previous tax year. Okay. Now try to understand. After 31st March 25 till 1st June 25, how many months? Can I say April and May? 2 months. I have to deduct accrued interest of 2 months, which is prior to purchase, less accrued interest at the time of purchase. So at the time of purchase, accrued interest was 2 months. I am getting 33. Now what is happening? During the tax year, Mr. Y has also sold the government bonds. If you are selling the government bonds during the tax year, then I have to take accrued interest till disposal. On 30th September 25, Mr. Y has received the interest. After that, November, October 25, November 25, December 25, January 26, Feb 26, 5 months accrued interest. I will add that. Add accrued interest till disposal. It's 5 months. So 10,000 into 2%, 5 by 12. I'm getting 83. So the final answer is 150. In this question, examiner, I think he has included all the cases. During there, Mr. Y bought the bond, and during there, Mr. Y sold the bond as well. So let me repeat the rule for you again. If during the year someone is buying the bond, then whatever interest you have actually received during the tax year, take that minus the accrued interest which was there prior to purchase or at the time of purchase. Another rule is, if you are selling the bond during the tax year, then in the current tax year, whatever interest you have received, that is your interest income, plus you have to take accrued interest till the date of disposal. That is also your interest income. So now I strongly believe, student, you should be in a very good position to deal with these government bonds. Kindly reply in the chat box. Is that clear to everyone? I'm waiting, students. Kindly reply. Is that clear to everyone? Okay, that's great. Okay. Let's see one more question. Question number 19. It's our first live revision class, so I don't want this class to be very long, but we'll be revising. through questions. So you will be getting a revision of, I would say, entire taxation, but entire taxation through questions. Okay. And the next question is, what about the topical revision? Topical revision, how we are going to revise? I'll explain the strategy, inshallah, around within the first week of April. I will tell you the strategy regarding topical revision. So there will be both the revisions, don't worry at all. You will be getting a topical revision as well as the revision through questions. And in today's class, student, you should have observed one thing. We are not only solving the questions. Within that question, whatever is the area which we have covered in the regular classes, I'm giving you the revision of that area as well. We are not directly solving the questions. Okay, how much premium of 82,000 is taxable as property income? Since April 2025, Nichols has let out unfurnished freehold office building. On that day, tenant paid a Nichols a premium of 82,000 grant. Basically, whenever you are giving a property on rent and you are getting a premium, the one question is why someone is going to pay me the premium. That person is paying me the rent. I should be thankful that that person is paying me the rent. In addition to the rent, why someone is going to pay me the premium? There's only one reason for that, and that possible reason could be the location of your property. It is very much possible that your property is at a very prime location. That is why your tenant is willing to give you the premium as well. This is the main logic of getting the premium. There's another logic also. Basically, if someone gives you the premium, that person technically also gets the right to sublet as well. But that sublet scenario is not in our taxation course. That is why I'm not going into that direction. Let me repeat the reason for you why someone will give us the premium in addition to the rent, just because of the location of your property. Okay, now, whatever premium you receive on short term lease is the lease which is less than 50 years. Okay, whatever premium you are receiving on short term lease, entire premium is not taxable. If you recall a student, on that premium, we get relief. So premium received minus the relief, after deducting the relief, whatever the amount comes, that is going to be your taxable premium. So the premium received is 82,000 less relief. If you recall the formula, relief is 2% n minus 1 into premium amount. 2%, n is the least term, 15 minus 1, premium amount is 82,000. Let me use the calculator. 82,000, let's take 28% of this. 22,960. I'm getting, students, 59,040. Logically, the taxable premium is 59,040. Taxable premium is 59,040. Okay, now student, listen to me carefully. I'm giving you a small homework. The homework is from question number 20. It goes till, I believe, 33. From question number 20 till 33, that is your homework, 20 till 33. I want every one of you to attempt all these MCQs. Of course, in any MCQs, if you have problem, you can always ask question in your relevant WhatsApp group, and I'm going to personally reply. Don't worry at all. But I would request, kindly do attempt questions from 20 to 33. Okay. And in the next class, students, we will be revising. Of course, there will be, number one, I'll be solving some of the question from this 20 till 33 also. In the next class, you will be getting a revision of employment income. Again, there will be MCQs on property income as well. But next class is going to be longer than today's class. It's a first class, that is why I'm not taking a long class. And as I just mentioned earlier, you will be getting a topical revision. Topical revision strategy I'll be revealing in the first week of April, inshallah. And question based revision you will be having. So there will be two types of revision in taxation course. One is question based revision, like in today's class, you can see that we have revised. We did not only solve questions, we went for the revision as well. So one, you will be having a question based revision, another is topical revision, and third, my WhatsApp support is of course available. So that is all about today's class. Is there anything you can ask? You can message me right now. Plus, do give the feedback on today's class in your relevant WhatsApp group as well. And student, first 6 chapters notes we have already shared. I think entire focus notes just within, I believe, maximum within next 2 weeks, you will be getting the entire focus notes on the entire taxation FA 2025. So thank you very much that you people have taken out times for today's class. Do give the feedback about today's class in your relevant WhatsApp groups. Thank you very much.